Hi, Itamar. Welcome to Venture with Grace. We're live.
Grace, I am so excited to be here. Thanks for having me.
Yo, okay, so let's start with should we start with like your journey in Israel? Like I feel like you're such an interesting person just because let's talk about like your journey in Israel and then we can talk about Life360 and then talk about the phone. What were some core lessons you have built? Like basically, you're the founder of military police anti-cyber crime unit
Oh
at
man, you know
Israel
about that? Oh,
Defense
that, we're gonna
Force.
talk about that. Okay, we're gonna talk about that. That's gonna be fun. It's gonna be fun.
Okay.
Um, okay, cool. So yeah, as a kid, I grew up in Israel, and I've always been this geeky computers kind of kid. I was programming
Mhm.
since I was 14. So when I joined the Israeli Defense Forces,
Mhm.
which is a mandatory service in Israel, I got picked up by some officer. They're like, oh, we've got all those hackers like breaking into IDF computers. Can you stop them? And I was like, yeah, I could try. So I did, and I ended up setting up the first military criminal computer crime investigation unit, right? Kind of catching the hackers inside the IDF. And that obviously was just like an amazing experience. Also working with the FBI and capturing hackers internationally and the Israeli police. And honestly, just taught me a lot about the world and the fact that there are some bad people out there, apparently. Um, yeah, so that was fun. And coming out of the army, it was 2000s, like it was still the bubble. I was like, okay, I know computers. I'm going to create a multi-billion-dollar startup like everybody else does, and I go on Nasdaq and obviously, little did I know that I have no clue about building a business, building a startup, putting together a team, selling software to the customers. So me and a friend, we built Intech Technologies. I was the founder, CTO. Actually, I was very technical back then.
Mhm.
And we sold this piece of billing software to the Israeli government. And we had one client, and they were paying us really well. So I hired 7 engineers at the back of it. It was like a full-blown startup. We haven't raised money, but it was just, we were bootstrapped and profitable. And then one day, my customer called me, and they're like, "Hey, nobody's really using your software. Can we just cancel this thing?" I was like, "What? You're like my only customer. If you cancel this thing, we're out of business." And indeed, we're out of business. And I had to let all my engineers go. And that was a lesson for me about and maybe I should learn about how to build companies before I actually jump into to build one.
Mm.
And that's how I started as an entrepreneur. And then I spent the next, I guess, 25 years just building startups. That's what I've been doing, for my entire career. First in Israel, moved to the Bay Area, 2010, so 15 years ago, and have, it's been a wild ride. So I'm a repeat entrepreneur. An executive. My last company is called Life360. It was a little bit under the radar until a couple of years ago, but now a lot of people have heard about it. We're publicly traded, $3.5 billion market cap, one of the biggest apps in North America. So actually more usage on a daily basis than Twitter. Uh,
Mm.
Life360 is called the family network, safety and peace of mind for families. Amazing application. If you have kids that are out and about with phones, you want to have this.
Mhm.
So that's kind of my last company. Before that, I was a very early employee at a company called Gigya that got sold to SAP for $250 million. So I've been part of 2 very successful rides, startup rides. And in parallel, I've been investing all along. So I actually started my career as an investor on Sand Hill Road, working for a firm called Recursive Ventures, and now called Canvas.
Mhm.
Amazing people. Learned all about venture from them. And then I helped start an accelerator called UpWest, which used to bring Israeli companies to Bay Area and accelerate them, and has had tremendous results. We were the first investors in Sentinel One and Honeybook and a bunch of other successful companies. Um, and after that, while I was building Life360, I was investing out of earlier iterations of Recursive Ventures. We're now in Fund 3. I did, Fund 1 and Fund 2, and have been, extremely fortunate to have invested in 7 unicorns at the very early stages. We've gone through 3 IPOs, a bunch of M&As, and just sort of the full cycle. And through all those experiences, I learned a couple of things. the first thing that I learned is that I'm a bad CEO,
Mhm.
but I'm great at supporting them. So that's kind of my destiny, helping
Mhm.
CEOs, and that I love the inception sort of early stage, like 0 to 1,
Mhm.
right? And I'm good at like helping people like work through that. Like, how do I get early traction? How do I get funded? How do I? So that's really what I focused on today with Recursive Ventures, helping founders, get from 0 to 1.
Mm. I have so many questions there. So like one thing is like when you were an operator and then you were investing in startups, like as an angel investor, now you have your own fund. Like I feel like one of the question emerging gets the most is like, okay, you have angel portfolio, but like how do you know deal like portfolio construction as well as like what to follow and what not to? And then basically another question typically like LPs will ask is like, okay, you were putting in 25K checks or 100K checks, but now you need to put in like 200K to 500K checks. How do you secure the spot in the hottest deals?
Yeah, excellent questions. I'll try to address all of
Oh,
them,
you
but
did. By the way, I just want to tell the audience your like angel portfolio is like phenomenal. Like the deal you invest in deal when it was like seed and like a bunch of like other Peerspace, Honeybook, Akash Network, and a bunch of other companies, SafeGraph. I don't want to like drop the whole thing, but like let's talk about like how do you basically how do you like convert from angel investing to a fund?
yeah, no, that's an excellent question. So first of all, because I was institutionally trained, I was aware of the need to have a strategy and
Mhm.
portfolio construction to begin with. So even when I was doing basically an angel fund starting 2014, which is when I started Recursive Ventures One, it was clear to me that I need to have enough depth on one hand, and on the other hand, have diversification in the portfolio, so we don't lose money, right? You got to balance between those two elements in your portfolio construction. So in my first fund, I did 30 investments in the fund, which is actually, if you look at what a lot of these sort of pre-seed seed funds are doing these days, that's a pretty, that's a sort of average number for a lot of these funds, because there's some data that shows that if you go over 20, 25 portfolio companies in the fund, you're kind of diversified enough to not lose money. And obviously, if you hit a winner, then there's significant upside for you because you come in so early in the game, right? And that's why super early pre-seed and seed, these funds have the opportunity to create completely outlier results, like a 10x fund, which I've actually experienced one in my second fund. It's a 10x fund. So you can do that with smaller pre-seed funds. But I think one thing that, and this is a great question about like transitioning from angel to VC and sort of professionally managing other people's money, is yes, you have to have a strategy, and your strategy needs to work. So for me, I was running 25 to 100K, 250K checks in my angel portfolios, right? I call it angel, but it was
Mhm.
still other people's money and my money, but smaller checks.
Mhm.
And when I went up to like 500,000, 750, even $1 million checks now, it wasn't actually a significant change compared to the 100K checks. Now I'll tell you why. The pre-seed stage is actually very collaborative. There's
Mhm.
a bunch of funds coming in. Most pre-seed rounds, institutional pre-seed rounds done now in Silicon Valley, which is the majority of where I invest, are kind of 1.5 million to 2.5 million.
Mhm.
And we create a syndicate with a bunch of people that we love working together. One day, maybe you and I will do a deal together,
Mhm.
because I know you're an amazing investor yourself, Grace. Um, and yes, and we all like we huddle up to help this company right together.
Mhm.
So it's very collaborative, and then that means that often, even if I want to write a $500,000 check, the founder, the other investors, they make room for me, right?
Mhm.
So I get my allocation. I don't lose those deals. Unlike, let's say, the Series A, which is
Mhm.
very competitive, and sort of the operating approach there is, if you're a big fund and you're going into the Series A, you're going all in, and you're going to try to squeeze as much capital into that company as you can, right?
Mhm.
So, yeah, so operating in the pre-seed and seed lets you scale up from angel checks to micro VC, small VC checks fairly easily without having to compete with everybody and their uncle.
Mhm. I feel you. So like I wonder how do you think about like saving reserves though? Like since like I feel like the main difference between like running a fund and like doing angel track is like the ownership and like basically especially in the seed pre-seed stage like there's only so many company that can really pull off later stage. How do you think about the reserve strategy? I mean, obviously, share whatever you can. Don't like, yeah, over. But I don't know, like whatever you think makes sense.
Yeah, yeah. I'm gonna say
I mean,
the
more of
top.
like a thinking framework than like the actual.
Yeah, that's a great question. And first of all, I don't necessarily have the best answer. Like different managers would have different answers, and that's okay. Um, I- for me, I kind of believe that you have to underwrite every investment opportunity from scratch, right? So now, obviously, if you have asymmetrical information because it's already a portfolio company and you've been
Mhm.
working with a founder for a while, then you have a lot of data points, and that helps you make a better decision. But I don't, and again, this is not a popular, opinion, and it's not necessarily something that founders want to hear, but I think it's fair, right? It's fair to say that I'm not going to automatically follow on or bridge a company unless they perform, right?
Mhm.
Because we have to invest in the companies that perform. Remember that us institutional investors, me included, I have people's money for their kids to go to college, pension, like all this money that people want and need. And my job is to make sure that they get appreciation. So we don't follow up automatically. My reserves are pretty low. They're sub 30%. Actually, not atypical for a seed fund. Lots of seed funds have lower reserves. And every time we have an opportunity to think about, doubling down or bridging a company, we think about it from scratch and we approach the opportunity from first principles. And if it's the right fit, we invest. If it's not, then we wouldn't automatically invest.
Mm. Um, I feel like basically saving, let's say like a seed fund's money to invest in. Well, uh, like obviously your fund is a little bit bigger than a lot of the other like first time like a for well like a lot of like the emerging managers because I feel like nowadays emerging managers ranging so big and like most people's like first three funds are very small compared to like a lot of other people's but like I wonder but I feel like when you're saving for reserve like you can only invest so much to actually get the ownership but I wonder how do you think about like, you mentioned about like each opportunity is like a different game. So basically you evaluating each opportunity differently. What would be your benchmark to evaluate? Is that like just based off like the traditional kind of like Series A benchmark, do we put more money in? Or if there is any actual benchmark, since I feel like you are more towards like generalist investor in the software space, but like because of different tools or like different companies maybe having different like ARR or like other metrics, how do you evaluate each opportunity differently?
Yeah, absolutely. So first of all, I am focused on data and AI, have been for a
Mhm,
while, even before this ChatGPT thing came out.
mhm.
And there was a question there about SPVs, and I'm going to address that. Thank you. Question from the
Yeah,
audience.
had
We'll,
wanted to say hi to
we'll,
the audience.
we'll talk about SPVs. That's a great point for us to bring up next.
Mhm,
Um, but I think at the end of the day, look, I'm a product guy, right?
mhm,
So I can look at the data. Obviously, we're all analytical. We're all making decisions also based on data or influenced by data. So if I see a company 4xing in a year, it's like, yeah, this thing is working, right? You can't ignore the data. But for me, I kind of try to peel the onion one more level
mhm,
and focus on real customer engagement, right?
mhm,
Are people using this? Do they like this? Are they using it on a daily, weekly, monthly basis as they should, right? Is it driving value? Is the value proposition that the company stands for aligns with what customers are expecting? So I try to uncover some of these nuggets to understand because what we really care about is how scalable is this product slash, go to market motion, right?
Mhm.
And if it works for a subset of users, and we can kind of understand that ICP and say, okay, this makes sense, then we know there's, hopefully, if we did a good TAM exercise before we made the investment, then we know that there's enough, folks out there that would buy this thing, and the potential is there. So that kind of goes back to that. And then I want to address the SPV question, because I actually do that quite often. And we basically have this approach at Recursive Ventures, which is, it's a solo capitalist fund, so it's just me, but I do have support and venture partners and a CFO and all those great people. It really takes a village. But what we do is we use the fund, Recursive Ventures, which is a $30 million fund. We're going to announce it this month, but I'm happy to kind of break the news here a little bit. We use that fund to find the companies, right, early on, like very early, pre-seed, just even at inception. And then when we see we have a winner, then instead of pulling in the reserves, we can do a little bit of that. We actually put together significant, sometimes multi-million-dollar syndicates to back these companies and kind of double down on winners. And a lot of my investors, they love that, because we kind of find the companies with the fund, and then when we really see them, hit success, we can, we've got the relationship, we're there early, we understand the motion, we understand where this thing is going, and then we can really, help the founders with a significant capital injection.
Totally. Okay. So quickly saying hi to the audience. Hi, Jerome. Hi, Ariel. Okay. So I wonder, yeah, totally news break, because yeah, Itamar just announced the fund on our show. Anyway, okay. I wonder, when you're thinking about like syndicates, I feel like the big problem of syndicates is like every time it's like raising a tiny fund, right? Like you have to fundraise. Like, I mean, speaking of like, I feel like running a media company, you have to like fundraise from customers. But how do you think about like keeping, like, I guess like using CRM, or like actually like keeping in touch with the right co-investors? And when you're selecting co-investors, like who are they? Like, so for example, to build a syndicate, I was thinking like you really have to like, there's like people who are interested in the particular deals, and then you have to also have like maybe a handful of people that you constantly just send to, just so that like, keeping the relationship warm, as well as like understand like each person's like taste and deals, because that's very different than, do I like you as a friend, but like the deal taste is also very um important. So how do you think about like actually ensemble a crew immediately as a syndicate? And then also like syndicating is like, also you have to ask the deal. Oh my god. Okay, so everybody's shooting their shots at you, but okay. So I have a question. Okay, so when you're like, let's say, when you're actually putting together the uh okay, let's just go with like how do you raise a small like syndicate, not small, but like how do you raise a syndicate, and like kind of keeping the relationship warm and understanding each person's like deal taste, basically.
That's an excellent question. So with syndicates, first of all, my limited partners, my investors in my fund, they have a right of first refusal to participate in our syndicates on a prorated basis. So really, the majority of capital for the syndicates is coming from fund LPs. Those could be family offices or fund of funds who are basically saying, yeah, we're in this, we are deploying a relatively small amount of capital into your fund so that we can potentially find those downstream opportunities to put much more money into play with the companies as they mature. So for me, the majority of capital that I source for these syndicates doesn't come from, although I do have an AngelList syndicate with, I don't know, there's a couple of hundreds of people there. But the majority of capital doesn't come from like, hey, here's $1,000 check here or a $5,000 check there. It's actually my existing LPs who are like, okay, we want to put $1 million into play with this one, right? So, and for me, the way to keep in touch with those folks is very similar to what I do with my fund, which is, just all the best practices that you can imagine, whether it's an annual meeting, quarterly newsletters, ad hoc updates. I do put aside every quarter a full day, and I just open up my calendar, and any LP that wants to jump in and talk about whatever, like, where is AI headed or whatnot, I'm there for them to at least weigh in on my personal view of things here. and kind of try to stay in touch. With all that said, I'm a one-person team and a one-person
Mhm.
show. There's nobody else, right?
Mhm.
So I kind of want to make it clear to my investors that I can't, like, I'm not BlackRock that has 100, investor relations associates running around throwing parties for folks. I'm focused on making people money, right?
Mhm.
And I'm happy to talk about it, but there's only so much I could do to stay in touch with them, and we try to keep them, on top of everything that we do and all the greatest and latest news.
Okay, I have like some questions there. So like first of all, like I know that like so to have existing LP, you have to have LP in general. So like because of this is your fund three technically. I know that the other two are like kind of operating fund as like I don't know like the earlier part-time vibe, but like before like so I guess like when you're raising the first fund, like what was the journey like to actually pull the LPs, and what were like the question that you were getting back then for Front One?
Well, Fun One was funny. I gotta tell you, Fun One was funny.
Dude, you have the best personality. I just want to say, like, you're like always so happy,
I try. Why not be?
naturally happy face.
I try to be positive. Most startups fail, so at least we can enjoy the journey. Uh, yeah, it was a little bit of anyway. Fun One was funny because I was already in a deal flow and I was doing angel investments, and obviously coming out of Morienter and Up West, I already had a little bit of a track record. So what happened was I was seeing all those deals and kind of sending them around to my buddies and a few funds that I was working closely that knew me. And at some point, one of these funds came to me and actually said, "Wow, like you just have all those great deals. Can we just give you some money and just go
Mhm,
with this?" And I was
mhm,
like, "Okay, but like I have a full-time job. I'm building a company. It's called Life360." And they're like, "Yeah, we know. Don't charge management fees," which I
mhm,
think was very fair because obviously I get my paycheck, but you obviously are entitled to carry because you're doing all this work, and just start with a little bit of money, and all those deals that you would forward to us anyway, keep forwarding them, but you can also write a check. I was
mhm,
like, okay, this is pretty cool. I'll do it. And that's how we got started with Recursive Ventures 1, which is a 2014 vintage fund. Um, that obviously went very, very well. We invested in Life360 in my company. We invested in Placer, which is a unicorn today. We invested in May Mobility, which is an amazing company on the right path. The only company in the US other than Waymo, which is actually driving out and about. Um, and we had like a small we did a secondary, we came into Ripple, and a bunch of other winners that credible that went public. So we had a few really amazing wins in that fund. Automatic, or I can keep going. And the first fund is always one of the best. And then coming into fund two in 2018, it was kind of obvious for the same people plus other people that we met along the journey that
mhm,
this thing is working. Like it makes sense. We should do another one. And 2018 was a tough year for me because I was the Life360 CFO and I took it public. We eventually went public in 2019, but I was obviously bombarded by taking a company public, which is not an easy feat and not for the faint of heart. But I was like, yeah, I just like felt that I have to keep supporting all these amazing founders that I'm finding along the way. So we did another fund in 2018. That fortunately went even better than Fund One. I was one of the first investors in Deel, which very recently announced they've crossed the $800 million ARR range and are prepping to go public. We've had other successes there. So quite an amazing fund.
oh, how did you like got into Deal?
Oh, that's a crazy story.
Yeah. Also,
So
hi Jelly. We're gonna address your question later, but okay, sorry. Please
yeah,
continue. Yeah.
so I knew Alex, the CEO founder of Deal, from a previous company. And he was this, I mean, honestly, back then he was a kid. He was this amazing kid. I think he was like 22 when I met him. And it was a previous company, and he was pitching me to do a small check. And I actually know his dad, Philippe, who's an amazing entrepreneur, built significant companies back in France, and then moved to Israel and built a VC there and a media arm, just an amazing person. And I was talking to Alex, the son, and this dude is like 22 years old, right? I'm like, wow, you sound like your dad. Like you're 22, but you have the wisdom of a 50-year-old entrepreneur. Like, how do you do that? And it was immediately obvious to me that this kid has basically been groomed to be an amazing entrepreneur. So when I met him the first time, I was like, wow, if he figures out something interesting, I want to back this guy, right? And then I met him, I think it was the first week of YC. And Deel was just, it really started as something different. I barely even recall what it was. They were just like hustling. And it was a different time in Silicon Valley. This is like February 2019, I want to say, where it was impossible to get talent in the Valley unless you paid them like $1 million a year. And there were a lot of companies back then, including my portfolio companies, that were hiring remotely engineers. And it was a mess every time. Like, how do you pay them, and compliance and regulation? You don't want them to go to jail in their local language, like country, because they're doing something wrong and all that stuff. And Deel was like, Alex was like, look, we're going to do a one click to solve this problem. I was like, wow, I know a bunch of companies that can use that. So I picked up the phone and called a bunch of my companies, like, yeah, we want this thing. And then I invested. It was a relatively small check. I was busy running my company, but I think ended up, like, everybody that invested in the pre-seed, essentially a Deel, probably one of the best, investments in history for all of us, because it went from, for me, a $10 million market cap to now over a $12 billion market cap in less than 5 years.
I wonder, so like, I guess, like, love that. And like, how do you kind of like repeat these like deal funnel for yourself? Just because like this sounds like a very unique situation that you already know the dad, and then like obviously like he has a huge track record, and then the son is like amazing. But I guess like, as I feel like LPs would just ask like, okay, what is the funnel for you that's like very unique? Obviously you personally have a really good track record as like, um not everybody is like a public company CFO, right? So like, but like on the other hand, like how do you translate that into like a deal pipeline?
Yeah, that's an excellent question. So I think it takes time and a lot of networking to really get to a point where, I mean, for me, I'm honestly bombarded by deals. Like, there's more deals that I get inbound than I can really tackle. So I got to filter pretty aggressively. And it's a combination. So let's start with the fact that I've already invested in 170 companies over the last 15 years. So just think about the number of repeat entrepreneurs that I've already backed, that are coming back for their third and fourth and fifth company, and just like amazing people that I want to work with again. So actually, the majority of my deals in Fund 3, the ones that I've already done with this fund, they're with repeat entrepreneurs that have been successful before, and kind of want somebody like me who's a solo capitalist, no headache, walked in their shoes, understands them best for this stage, right? For pre-seed and seed. And we'll talk more about, I hope, why solo capitalists are successful in a different part of this.
Need that. Like, that's like on the next topic, but keep going. Sorry. Let's talk about deal funnel. But
So obviously there's all those people coming back. We've worked before, love working with them. And it's not just them, it's other entrepreneurs that they know who are like, hey, you're starting a company? Wow, you should talk to this guy, Itamar, because he's been one of the most helpful people early on, right? And it's also their star employees. So I get a lot of phone calls from my ex-CEOs, or maybe they've sold the company, maybe they shut it down. It happens all the time. And they're like, look, I got this star employee from my previous company. This guy's great. He's starting a company. Can you help them out? And I love being the guy that helps out. I'm like, yeah, sure. Like, I'll talk to them. I'll see what can we do, right? And then another piece of what I do, which is very critical, is I have a superpower. And it's only one. I don't have many superpowers. I can help founders build companies, but in many areas like sales, go to market, I think there's better people than me. But I have one superpower. And that superpower is helping founders fund their company's subsequent funding rounds, raising institutional seed rounds, Series A, Series B, even doing an IPO. I've done all those things hands-on, right, myself. I've actually raised over $400 million for my companies.
Mhm.
And that really helps me. And I've helped over 50 of my companies raise Series A's and beyond. And because I come from institutional venture and I've been an angel investor and I've been a builder and went through all those stages, and I've got a massive network of VCs, that really helps me, push my founders forward to get their Series A done. And it's easier for me to do that than actually for a lot of bigger venture funds, because there's a lot of signaling that happens. Let's say Sequoia sends a deal to Andreessen, and Andreessen is like, why isn't Sequoia doing this deal, right? And with me, it's kind of clear. It's like, oh yeah, obviously Itamar writes the first check, and then he just bats for the company and like goes out and try to get the best investor to follow on. So there's no kind of negative signaling when I make introductions, when I put my companies in front of investors, and that really helps me to help my companies, right, raise the next round.
Mm. I wonder, so like when you are the other part is like we're talking about like solo capitalists. Like right now, I feel like almost all my emerging manager friends are like solo GPs. No, not all of them, but like I would say like let's say 80% of them. Like why do you feel like solo is the best way? Just because I constantly feel like I feel like it's always like there's so much advantage to like have like a thought partner, just because like I feel like starting a fund is like a very um sophisticated process. I what is it sophisticated, but it's like a really manual process. Like people kind of don't like people underestimate how much work it goes into like actually manage the fund at like running these like sending these like LP updates slash newsletters and like managing different system in the back end and like actually tracking every deal, thinking about if you invest or not, like doing the math and like fund construction and LP management. It's like a full on, like, I don't think it's a one person job, though, like, everybody's a solo GP. So I wonder, how do you like stay alive in this situation? And like, why do you feel like solo is the best way?
Right. Okay, so a couple of things. And I do believe that solo is, for a lot of people, it's the best thing at the pre-seed stage. And I'll explain why in a second. But
Mhm.
just to be clear, I agree with you 100%. A single person just working by themselves, trying to do all of these things, it's just too much, right?
I feel like it's a lot of it's like mentally exhausting. Like, who do you chat with? Let's say if a LP, if like an anchor LP just pull out immediately, or like some like random stuff happen, like five portfolio company die in one day, or like I don't know. I'm sorry, but like,
Happens that shit hits the fan, as they say.
yeah,
Um,
yeah.
so first of all, I think you're absolutely right, and I want to be clear. I'm a solo GP, so
Mhm.
I'm the sole investment decision maker, and I do most of the investment work in my fund. But I have a CFO, Evan, great dude. He does
Wait,
all the
how
back
much
office.
does okay, can I just say, like, like, is it that super expensive to have a CFO or, like, so the back
Well,
office manager or something?
yes, but it's the right thing to do for my LPs. And look, I know this is going to be hard to swallow a little bit, but I'm not doing this for the money. I'm not doing this for the salary. I'm not playing the AOM game, which is another conversation we
Mhm.
should have at some point. But
Oh,
like,
yo, we should. For the
but
AUM game.
so I mean, I think VCs should be doing their job compensation wise for the
Yeah,
carry, right? We're
right.
supposed to get paid when our LPs get paid, and the folks that are playing the, oh, I pay myself a $2 million salary a year out of management fees. I think they're not doing justice for the asset class. It's just my point of view, but anyway, I'm the only decision maker. And yes, I do most of the LP conversations and most of the filtering and work with companies, but it actually takes a village. So I have two venture partners. They're
Mhm,
amazing. Actually, both of them are way smarter than me. Like,
mhm,
and I have rely on them heavily. I never do a deal without having a venture partner or a venture advisor also involved, right? Because I come from an institutional VC background, and I have a lot of respect for having, a group of people actually think through all the shortfalls, right, and all the issues that this thing could have. It's very easy to fall in love with companies and deals and kind of get blindsided, like not really thinking about all the things that can go wrong. So having another person in the investment process is extremely important for me, and I almost always have that. And we've got a very institutional process. Now, at the same time, what I've seen in my 15 years of being in and out and part of the venture community is that partnerships are not always very effective and conducive. So what founders really want is people that have walked in their shoes, are unhindered by VC firm politics, right?
Mhm.
And just like give them like actually like tell them why they're investing or not investing in a very clear, succinct way, giving them a clear signal so they can operate, so they can move on to the next investor, so they can get this round closed, all that stuff. The dynamics created in partnerships in bigger VCs are not conducive to that. And I'll give you some examples. Why the hell, sorry for using that word, in a partner's Monday morning meeting, why would an enterprise GP shoot down a consumer deal that they have no clue about? They're an enterprise investor and they're voting and they don't have the context. They don't know the space. They don't know, they're not consumer investors. So why are they voting, right? Why are they shooting this deal down? And what about the fact that, and this is like, we all know those are real stories, like they exist. The fact that, let's say you and me were partners in a partnership and I didn't like your last deal, so I voted against it. And you're like, no, now the next time Itamar brings a deal to the table, I'm going to shoot that down. It's like all this.
Oh, okay. Drama, basically.
Just think about drama. Yeah. Just think about this thing. It's a partnership of sort of equals versus a company that has a CEO, like a final decision maker.
Mhm.
I believe having a final decision maker is actually the right approach to winning in venture, because you have to bet with conviction. It's the contrarian bets that really make things work. And if you have groupthink and everybody's saying the same thing and you do it over again and again and again and again, I think your venture fund is going to suck.
Mm.
So, and partnerships lead to that dynamics, which again, I think is A, not that great. B, it's not actually a good fit for pre-seed founders who just want a single person who's walked in their shoes and can give them a yes or no answer. And that's what I deliver.
Mm. Wow. Okay. So another question is, you mentioned about like venture partner, you have CFO. Like, how do you kind of like construct your company slash fund, and like how do you kind of incentivize the venture partners?
Yeah, well, they all get carried because luckily I have 100% to start with. So, uh, I mean, I don't think people should work for free. Everybody should get compensated. So for me, it's a priority to compensate all my advisors, and that's what I do. But also, and I've got two venture partners, another 20 plus venture advisors.
Mhm.
Everybody is like folks that like we all love working together. Everybody loves startups. We love supporting startups. Bunch of people are retired. They've already built their companies, IPO'd them, whatnot.
For sure.
We're really here for the next generation. And I got to tell you, and again, a bunch of folks might look at this and say, oh, Itamar is just BSing us. He's like, there could be cynical. I do my job because I love doing this job, primarily for that. And a secondary consideration for me is making money. Obviously, I got to make money for my LPs first because, I got to take good care of them. But I'm not doing this job because I need the money, right?
Mhm.
I could return.
You're good. Basically, after the IPO, you're set.
Yeah, and there's only so much one person needs, even after you donate and give away to causes that you believe in, and I have many. But really, it's for me, it's about that journey with the founders early on. Of like, oh my God, we hit a wall. What do we do? And kind of the creative thinking about how do you figure this journey out right early on. That's what I love doing. And most of my advisors are people that love doing that as well, right?
Mhm.
They're collaborative. They work with companies. They advise. We don't tell founders what to do. If you have a VC on your board who's telling you what to do, they're not doing their job. Okay, they're not doing their job. They're getting in the way. We don't get in the way at Recursive Ventures. We just help, ask tough questions, make the right intro at the right time, and that's really, it's a little bit of a non-VC point of view. Like I also don't take board seats. Again, I don't tell my founders what to do. And our advisors are the same, right? They have the same ethos around we're here to help out and we love doing it.
Mm. I wonder, so like as an early stage investor, like do you take board seat, or like do you be a board observer? Like what's even the difference between like board board of director versus observer.
Well, there's
I
a
heard
huge
it. Oh, really? Okay, what? Like,
well, board directors obviously vote on board matters. And
oh, okay, okay, okay.
there are times where, that vote could be extremely critical. You could shut down an IPO.
Oh,
You
wow,
can
really?
fire the CEO. There's a lot of things that
Okay.
you can do as a board director. As a board observer, you don't have voting rights. You're basically observing. You could obviously be part of the conversation, but you're not voting. You're not a decision maker on the board.
Right.
You typically don't participate in committees, which what happens when companies evolve. Um, and that's kind of the main difference. But I think for me, no, I don't take board seats, and I'll tell you why. Two main reasons. One is I don't have enough time to do it. I have 170 portfolio companies. How would I be on so many boards? But more importantly, boards could be at times potentially misaligned with the founding team and the
Mhm.
management team. That's part of what a board does. A board is there to oversee, right? To make sure to be a fiduciary of the investors' money, right? Of the investors in the company. And sometimes that creates friction with the founders. And I don't want to be in that place, right? I'm not seeking
Mhm.
to be in that place, which is also why I run a smaller fund. I don't run a Series A fund. It is intentional. I could run a Series A fund if I wanted to, right? But I don't want to because I'd rather be more like an institutionalized angel on steroids that is there. Like I'm the person that people call when S hits the fan, right? And they know that I'm going to give them advice that's focused on helping them solve the problem
Mhm.
versus, coming from a board standpoint of like, you do your job or you're out, and like all those situations that I don't like to be in. So that's why.
Got it. Okay, I have 5 other questions in this domain. So one thing is like, okay, so if like a portfolio company that you have put like a small check in and they're asking for like 5 intros, and then like they're all like your biggest advisors, like, the people that you call once a year or something, like how do you manage like the introduction to like from Portco to other people? Also for like other VCs, like so for example, um let's say like a startup you have invested in, like, and then they're asking you for introducing them to 5 other investors, like, which is like normal, like, I mean, of course, like if you can help, great, but like, but you can't just like pass along so many deals to like the same guy or girl or whatever, like, so how do you think about like vetting the intro? Oh, another question is like, okay, look, so like we have like these advisors, right? So like the advisors, and then like you let's say you help like leverage the advisor to make a decision on if you invest in a deal or not, right? Let's say you are doing I don't know, like a makeup AI company or whatever, you introduce them to the SVP of Sephora, and then the Sephora person took the meeting. Was it because of you or was it because of that startup? And then after you follow up with them, like what kind of question do you ask people? And like, you can only send like so many things to the leaders at a big company because like they're super busy and they can't just vet all your startup stuff. And how do you navigate that kind of situation? And what if like you didn't even close the deal? Let's say they gave a really bad feedback. They're like, okay, this is like complete BS. And like they just can't kind of also cancels you as an investor because they're like, oh my god, I really do not want to receive these like BS deals. If that's the case, like how do you move forward? Or like they just got a check from the advisor instead of yourself, like how do you kind of like just like funnel these like kind of emotions or
Yeah, so
to
I mean, the starting point is always think about both sides. Like, is this, and always have like double opt-in, right? Like, I don't intro people to other people right away. That doesn't
right,
work that way.
right.
And I try to think about both of these people in my network, and like, does it make sense? Would this be genuinely interesting and sort of the right person to have a conversation with? And if I don't believe it's true, I'm just going to say it. I'm just going to tell my founder or my company, look, guys, I don't think this is the right intro for you guys. Or alternatively, I'm not the right person to make that intro. Maybe you can find other ways to do that, right? Um, but it feels very manageable for me. And I want to clarify one thing. I am not like, if you're looking for a VC that can make a lot of customer intros, that's probably not me. And I'll tell you why.
Mhm.
To make a lot of customer intros, you have to be in touch with a lot of big corporations or like mid-size, whatever corporations. And you typically need more of a partnership like a Sequoia, where they're
Right.
systematically creating relationships like that with customers to
Mhm.
kind of, be able to put their companies in front of them. I'm too small to do that. Where I focus on intros is in two areas: investors, follow-on investors, right? Series A funds, and advisors, either in my network or my venture advisors sometimes, right? If it's a good fit. And in those areas, there's just enough pacing going on that it works great. So at any given point in time, I probably have like 3 to 4 companies fundraising,
Mhm.
and obviously it's a process, right? It's a fundraising takes a couple of months typically for a Series A, sometimes even 6 months. So as you start thinking about, let's say, how many intros do I make to fund X of portfolio companies that I have a high conviction in, that I'm an investor in, that I've vetted again, and I know that they're headed in the right path, right? I probably don't do that more than like once every other week or every 3 weeks. So I don't feel I'm bombarding my friends and partners in the venture community with sort of my deals. I do 30, 35 deals in a fund. I don't do hundreds like other folks, which great strategy, but that's not what I'm doing. I'm much more concentrated as a seed fund. And because of that, the pacing really works out. And I'm saying that because I've been doing it for, gosh, like 14 years, and I know this is the right pacing. Now, if you tell me, hey, Itamar, can you double the number of deals that you do and do 60 like investments in a fund? I'd probably say no. And one of the reasons I would say no is exactly what you just pointed out, that I won't be able to help and intro 60 companies to the right people. It's just too much. So I really have to pace myself, stay within the guardrails of the fund strategy, and then have enough bandwidth and sort of social capital to help
Mhm.
those companies succeed.
For sure. Okay, so speaking of like this 30 to 35 deals in a fund, right? I was trying with like Tony from True Venture the other day, and then his advice was like, if you're doing like a 10 mil or like below fund, you just do 10 deals. But I'm like, oh wow, that's very high conviction. I especially when you're like at a very early stage, how do you even know? I feel like everybody is just like indexing everything. Like, I think LP hates indexing because LP is already indexing you. Um, but like on the other hand, it's like, okay, but if you took like a really, really high concentrated thing, like early stage company statistically just fail most times.
Right.
Um, how do you kind of like think about how many deals to invest? And then also like, do you invest the same check size for each deal? And then what if it hits like a really high valuation? Let's say a deal coming out of, I don't know, first employee of OpenAI, like not first employee, let's say like first employee from OpenAI or like DeepSeek or whatever. And then they went out there and then they're like raising mega rounds, like, let's call it like value at like 150 mil or something. Do you put check in or no? Because I think as an angel, maybe, but like as like a institutionalized fund, you're like, okay, are you kidding me? Like, you probably have to stay within a range. Like, how do you kind of like do the mental math on that kind of stuff?
Yeah, well, it's on the portfolio construction. And look, when you're managing other people's money, you have to have a framework. You got to be consistent with how
Mhm.
you make decisions, and you're a fiduciary of your LP's money. You got to take it seriously. So no, I'm not playing the angel game. No, I'm not going to do a check in $150 million post money valuation in a company that just got started just because this woman is from OpenAI, right?
Right.
Um, and the reason I won't do it is because it doesn't fit the model. Because I don't see a world where investment done at $150 million post money valuation is going to be a 100x investment. It just doesn't exist. Well,
Exactly.
it
It
does.
never work. Yeah.
It doesn't work, and that's not really the right portfolio construction for my company, for my fund. Now, in terms of how to do that portfolio construction, you really have to find the right balance between three different things. One is diversification. So as you mentioned, rightfully so, the more companies you have, the more diversified you are, the less likely you are to lose money. The magic number, and I tell this a lot to angels, people that come to me and say, hey, I want to start writing angel checks. I'm like, okay, can you write 20 angel checks? Because that's the number that you probably need if you have a high quality deal flow to hit a winner. You need 20 checks to hit a winner minimum, right? And if you do 15 of them, 10 of them, you have a high likelihood of hitting zero, which means all your money is gone. So you just have to have enough companies in your
Mhm.
portfolio to hit that diversification mark. So that's one consideration. The second consideration is capital concentration. So this is a counter consideration to the first one, where you're saying, okay, but I need to have enough skin in the game. I need to go in with a big enough, amount of dollars, and I need to be able to double down, right? So I need to be able to win pro rata rights or whatnot to really ride this thing all the way if it works out. So you also have to have that balance between diversification and concentration. And the last piece, which is really what's dictating my business, is what's your pacing? How many deals can you do? I can't do a deal a week. I can't even do a deal a month. It's just too fast. If I do that, my quality would go down. The quality of my portfolio would go down. I'm not interested in that because I'm not playing the AUM game. Funds that play the AUM game are trying to grow their fund size at any cost. They're just looking for reasons to deploy capital. I'm not. I'm looking for high quality deals that will net 100 plus X. And guess what? There's only so many of them in Silicon Valley, right?
Mhm.
So I don't subscribe to the spray and pray approach. I like to dive in, help out, concentrate capital if we have a winner. And that's where I found my balance between 30 to 35 companies in a fund. It gives me enough diversification. I can still concentrate in capital in a winner,
Sure.
and it's really in line with my basic.
Mm. I have a question on this. So, like, basically, I agree with you. Like, having concentration is like very important, and uh, not play the AUM game. But okay, so let's talk about like LPs. So, like, when you're fundraising, how do you get your first LP? Like, who should be like? Are you trying to, let's say, target like 10 super warm conversation and then land like a big anchor first, or do you just like spray and pray on, like, not spray and pray, but like just DMing everybody? It's a numbers game after all. Like, I've constantly hearing people on our shows as they're like, the big funds maybe chatting with like 600 plus LPs, the small funds may chat with like 2,000 LPs. Like, so everybody's going after the same target, or like, I don't know, same group of LPs. I don't even know if it's the same group, but I wonder how do you think about like the first do you do the very high quality small batch of people first to land an anchor, or do you go for the spray and pray, like small investor, everybody 50K check in vibe?
Yeah. So first of all, your first LP should be you.
Oh, okay,
You
yeah,
have to
sure.
believe in your ability, and you gotta have a skin in the game, right? So
Mhm,
obviously, GP contribution to merging small funds is a topic, right, with LPs,
mhm,
as it should be. Um, so I, I don't want to create artificial barriers of entry to the emerging VC category, but I think you need to have some money to get this going. And I would also argue that you have to have some venture success or some startup success to do this. Otherwise, it's kind of really hard to get going. But everybody can make their own choices. So you're the first LP,
mhm,
whether it starts with you being an angel or putting a big check in your fund. Then I've only raised one institutional fund, so I don't consider myself an expert. But I would say a couple of things. First of all, I think you really have to understand your target, right?
mhm,
So for me, I just raised a $30 million fund. That's not a good fit for bigger institutional LPs because these guys are looking to write 10, 20, $50 million checks. And no single LP is going to want to have more than 10 actually, top 20% of your fund. Raising a fund is more like a big party round, right? It's like there's a lot of people coming together, sort of throwing a little bit of money in, a little bit in their terms, right? Like there's big LPs there where a $10 million check is actually a little bit for them.
mhm,
So you got to know your target, and LPs come in all shapes and forms, right?
mhm,
So you got to know what your target is, and if you're not sure about it, ask people or go to Coolwater. It's great programs out there that help uh, GPs get off the ground, and you'll get good orientation on what types of LPs you should kind of hit. The reality is today, and it's been that way for a while, for sub 100 and especially sub $50 million funds, most of the institutional guys don't play. So you really have to be kind of chasing down family offices, smaller fund of funds, and high net worth individuals, right? The endowments, the pensions, like these guys are not gonna, it's not gonna work, right? Um, and yes, you do end up. So for me in Fund 3, I have 75 LPs, which is quite a bit. I'm pretty transparent about my fundraising. I talk to over 500 LPs in
Mhm.
person or over Zoom to close 75 of them. So it's a lot. It is a numbers game. It's
It's a
a
high concentrated. Well, I think that's a high hit rate, honestly, compared to many people. Um, for the people you're meeting on Zoom or in person, do you batch people all together and like do you ask for advice or do you just be like, hey, yo, I'm like raising this fund. You want to hear my pitch?
no. I'm like, hey guys, I'm making money. Do you want to make money? I'm kidding.
Oh
Uh, no, I mean, look. It's an exercise in building relationships. It's exactly
wow.
what founders do with us GPs. We do as GPs with LPs, right? When I'm fundraising, I'm upfront about it. I'm like raising a fund, but I don't expect you to invest day one. And let's get together and let's get to know each other, right? When I'm not fundraising, I just hang out and talk to people and get to know them better. Because look, investing is all about building trust and confidence, right? Like money changes hands because you trust me and I trust you, right? So I don't expect people to trust me out of the gate. They got to see me perform. They got to watch me online talking to you, Grace. Like this is how it works. And you have to play the game and you have to build relationships, and they've got to be meaningful relationships for you and for the people on the other side, and that's how you get there. And yes, it takes a lot of time. And the last thing I would say about that is I think too many people have started venture funds. Too many people are trying to start venture funds. And yes, there's a sexy side to this job, but I don't think it's for everybody. And I think we have too many managers out there today.
Hmm. Um, okay, so would you say I like your pitch, right? Like would you say like would you have to like go beyond to ask for a warm intro from the other people? I mean, I feel like everybody does at some point, but like I guess like let's say the 500 LPs, do you have to ask like friend of friend or like do you have to be like are they have to be like your immediate connection that who have been like your BFF for like the past 40 years? Not
Yeah,
40.
I haven't been successful with cold calling, and I also urge entrepreneurs trying to reach out to me. I don't respond to cold calls. It's got to be an intro. It's got to be a warm intro. So yes, I went out and very transparently, I put it out there and I said, "Hey, I'm raising a fund. Can you help me?" Right? Do you know people that invest in funds? I'm proven. I can make them money, right? So they should talk to me. And yeah, I do events, I travel, I participate, I'm a speaker, panelist in a bunch of things. So that obviously helps me get in front of people.
Mhm.
But most of the conversations came from warm intros. Yes.
Mm. Oh my god. Time passed by so fast. We're already at 58 minutes. Oh my god, I'm
We
crying.
didn't even take audience questions. I feel bad.
Yeah,
Like,
yo, let's address one audience question. How do you incorporate Jolly asked, how do you incorporate impact into your strategy fund? How much is this truly a criteria? Or this one, Jerome, adoption, consumption, time value, proper. I don't think it's a question. Okay, let's do this one.
okay, the impact one.
Yeah.
Okay. I'm going to be completely straightforward about this. I don't focus on impact.
Mhm,
I believe in impact. I believe in impact investing. I
mhm,
believe in a lot of things that I think most people on this show believe in as well. But it's not what I'm focused about on
mhm,
because I'm a one person show.
mhm.
I'm going to make money from my LPs, and impact is not a significant criteria in my investment decisions. So,
Wow. Love that. Okay. So, I mean, well, in the end of the day, I feel like each GP need to pick a sector and then make money. So, like, how, I think that's impact on its own. You're like creating jobs for other people, as well as like, yeah, creating jobs is a huge impact. Literally, Jack Ma said that in like the Harvard Business Review. I was like, wow, that's like actually good.
no, it is. We're fueling the economy, and I feel good about what I do. And I don't want to play this game of pretending to be
Mhm.
impact focused when I'm not. A lot of people are doing it. I don't feel it's genuine. If you are an impact investor, all the power to you. I love people doing that. Maybe I'll do it one day myself, but it's not really how I make impact in the
Mhm.
world, which is helping founders build, you know, amazing companies that, Deel, the portfolio company that we talked about, has 5,000 employees, right? That's 5,000 homes that are being fed and happy employees that, live fulfilling lives. That's, for me, that's all I need.
Mm. Okay, so let's go to the last one minute fire round. What's your favorite book?
Oh, Gen Z. I don't read books. I watch like YouTube shorts.
Same. Like I mean, I listen to books. I like shout out to John's book. So like I had him on the show. It's a sales book. Yeah, like that was the my most recent list. I mean, it's your fair round. I'm sorry. I don't know why you make me too comfortable.
No,
I
no, no,
start
no.
scaring
What's
myself.
your favorite book? Come on,
Okay.
let's flip this over.
Yeah,
Like,
yeah, yeah. Okay. So you know what? Actually, where's my phone? Okay, it's here. Like, I only listen to books, so like I
hmm.
shouldn't say this, but like, yeah, yeah. Okay, Qualified Sales Leader by John McMahon. I can never pronounce people's last name. He was a guest last week. I've been just like listening to his book. It's pretty good. Okay, who made the biggest impact in your career?
Probably my mentors at Morgan Taylor Ventures, people like Mark Owens, who's an epic VC and angel investor. And then my longtime partner, Chris Holes, who's the CEO, founder of Life360, just this amazing. I call him a kid, although he's no longer a kid. But I mean, he started Life360 out of like his dorm and as an undergrad at Berkeley, and
Mhm.
he never quit. He's been at it for 18 years. So many people along the way told him that he's going to fail. I still have a list of 70 funds when we went out to raise our Series A that said no and no and no again. And he never gave up. He just kept going. And look at this. 18 years later, the guy's is the CEO of a $3.5 billion
Crazy.
market cap public company.
Oh my
So,
god.
yeah, he's a great guy, one of the smartest people that I know.
Who would you invite to your dinner party?
Who's what?
Who would you invite to your dinner party?
Who would I invite to my dinner party? Probably Sam Altman, so I can fight him over why the hell are you saying that AI is not going to take people's jobs? It is. Like, let's actually face this and start dealing with this as a society instead of digging our hands in the sand.
Mm. Where can we find you outside of work?
Where do I like working from?
No, where can we find you outside of work?
Oh, either skiing at Tahoe or doing a lot of international travel. I just came back from Argentina. I'm going to Costa Rica for Raise Latam actually next month, and then doing a lot of travel with my family. So
Mm.
I am trying to be out and about and active.
Love that. Well, Itamar, thank you so much for coming to the show today. It was such a fun conversation.
Yeah, thanks for having me, Grace. This is awesome. Let's do this again. Let's do more of this. And thank
Yes.
you so much for the role you play in, like interviewing some of the best VCs in the business, some of the best leaders in the business. You've been amazing to just, keep track of. Like every day almost you have this amazing content out there, amazing speakers. Honestly, I'm just really flattered you even picked me to be on this show. Thank you so much.
Thank you. I appreciate you. You're the best. Okay. Let me quickly end stream.